Commodities are back in focus as inflation and geopolitical tensions linger, but recent moves in oil have been anything but straightforward. So for investors looking at this space right now, is this a real opportunity or just more volatility? Hakan Kaya is Senior Portfolio Manager at Neuberger Berman, joins us now. Hakan, great to have you.
Thank you very much. Thanks for having me.
So this is an ETF Spotlight. The fund is the Neuberger Commodities Strategy ETF, ticker NBCM. We'll get to that in just a minute. But first, make the case for commodities right now. Why should investors be paying attention?
I think, it's very simple. We are in a different regime right now. What is new in this regime is inflation. Your stocks, your bonds, anything that's stuck in the skies, bonds in the skies, they are all impacted by this inflation. Anything that's cash flow discounting, that will get the similar treatment. Your REITs, your tips, they are all in the same basket. So what you need is something that's not cash flow discounting. It's pricing what is going on right now, and commodities, that's it. They are spots, assets. They don't think about future. They give you what the scarcity is right now. And I think in a way, kind of like they are filling in the gap for that missing diversification you are having in the stocks and bonds. I think you will need more of these type of store of value assets, inflation hedging assets. I think they will reduce your portfolio volatility. They will reduce your macro economic sensitivity in your portfolio. Very much required in these times.
Okay, so let's take a step back. When we say commodities, what do you actually mean? Energy, metals, ag, and where are you seeing the strongest opportunities today?
Of course, when I say commodities, this is across the board, anything tangible that you can touch, from oil to base metals, to precious metals, to, food and livestock, across the board, we would think that you can find opportunities. Of course, today the energy is under spotlight, very expensive, very volatile. I think going forward, you can see some spillover effects from energy to the rest of the space. You can see, base metals getting impacted through, again, Strait of Hormuz. Not much aluminum is coming out, again, coming from Strait of Hormuz, actually not coming, sulfur, that is going to impact copper production in the months ahead. Again, kind of like not coming out of Strait of Hormuz. We have a fertilizer issue. And these are going to create problems for the next crop cycle in wheat, in corn, in soybeans. So across the board, we see either energy inflation or food inflation, or, again, livestock inflation. We will just need to get ready for paying more for those beefs that we really like to grill during the summer.
Commodities, though, have been a tough trade for long stretches. And as you pointed out, we have seen that pull back really sharply from recent highs in oil. It's still up significantly this year. How should investors be thinking about risk? Because I've had guests come on and they've said you don't invest in commodities, you trade commodities.
I think certainly true. Commodities, if you look at them individually, they are very volatile, and it's idiosyncratic to its nature. There is no escape from that volatility. But when you look at them as a basket of commodities, the natural uncorrelation between them significantly reduce that volatility and make the asset class very investable. As a matter of fact, when you look at a commodity basket or a commodity portfolio, its overall volatility is lower than your NASDAQ stocks, perhaps it's sometimes lower than your S&P 500. So that uncorrelation between the unrelated commodities, they really make the portfolio look safer. So in this age, in these times, you see kind of like energy in the spotlight, very volatile. And to be honest, the implied volatilities of energy is around 100% right now. It just looks like a binary bet. So rather than just, focusing on your attention in just one sector or a few commodities, I think it may be a better, investment policy to diversify, do some risk diversification, do some risk budgeting, away from the already impacted energy commodities to those things that are also, proxy bets, but that are also cheap and less volatile. We try to prefer this risk diversification. We think, we've seen the ups in energy, but potentially we see these spillover effects in the rest of the space, especially in base metals, and then agriculture, and towards the end of the year, we will continue to see the impacts in the precious metals when we start thinking about those debasement rates, when we need to pay for the expenses of the defense spending or through the war, or kind of like the inflationary aspects that we are seeing from the fiscal profligacies and kind of like the printing.
So let's talk about the commodity strategy ETF. Where are your biggest exposures in the fund right now?
So we are currently, at par with energy and trying to balance that with, allocations into precious metals and base metals. Again, our understanding is, we can escalate or de-escalate from here. If we are going to escalate, we are going to see escalation. We are going to see the upside from our energy positions. But if we go into a de-escalationary, regime from here, I think it makes sense to have those commodities that got cheaper in the past few weeks or a month, things like gold, silver, platinum, palladium, or copper, aluminum or nickel and zinc, to be kind of like present in the portfolio to get benefit from these relief rallies and get benefit from this, potential kind of like back into growthy type of environments. Remember, prior to the crisis, we were in that era of the world economy is in an easing mode. 90% of the GDP is in monetary easing conditions, and also on top of that, we have the fiscal expansion not only in the United States but also across the globe. So we can quickly go back into pricing that particular regime, and you need, base metals, you need the precious metals to be able to gain exposure to that regime. So yes, we are, balancing the risks between energy upside and the potential de-escalation paths from here.
Where do commodities fit in a portfolio? What's a meaningful allocation for an everyday investor that actually will move the needle?
Yeah, certainly. I think, look, commodities are not traditional assets. A lot of people may have some aversion to including this asset class in their portfolios, add tracking error to their portfolios. But I think this tracking error is very much, in my opinion, will be needed in portfolios. So our understanding is, if you can stomach about 2.5% tracking error to your typical 60-40 portfolio, a typical allocation, I think that kind of like translates into 5 to 10% commodity allocations in traditional portfolios. And with that, you gotta have to think about for example, what it can do in your portfolio, that kind of allocation. And in these kind of like years, already commodities up as of today, 20-25%. In years like 2022, when your stocks and bonds are declining in two handles, commodities are going up in 30-40%. So you really can have ability to buffer those periods where stocks and bonds, they join on the downside, but commodities, they bring up this convex payoff. So you don't want to overwhelm your portfolio with commodities because they don't produce yield or they don't produce income. But you also don't want to put too little, because then you don't see it doesn't move the needle. We think that about 5 to 10% allocation, or a range between them is a happy medium. And these times are times when you would like to be on the closer to the upper end of that range.
Mm-hmm. I was taking a look at your fund. It's already up about 25% year to date. So for investors thinking, well, I don't already have commodity exposure in my portfolio, am I too late? What's your response?
Look, I think like I said, we are going into a new regime. We would like to call this regime are identified with 6 disruptive Ds. You have divestment in the asset class. Basically money is not going into the energy companies, the miners and the food producers because of the poor returns from the previous era. You have the decarbonization, not necessarily to solve for the, climate risks, but again for, self-sufficiency or energy diversification needs. You have the data center demand now. It's again a space race to get that computational dominance across the world. And for that, you need to build these data centers very quickly. With hyperscalers will hyperscale, and that will require a lot of demand for things like aluminum, copper, grid building, and also LNG and natural gas for fueling these. You need to de-risk your supply chains in this era of deglobalization. Go from those just-in-time inventory management to just-in-case inventory management, and then you need to do a lot of stockpiling, so that de-risking is going to be important. On top of that, you need understand this de-dollarization, de-fiatization regime, where you can see kind of like the dollar is itself getting weaponized in foreign policy, and central banks are not blind to this fact anymore and buying more and more of those neutral assets for reserve management, and nothing gets, for example, more neutral than gold. And finally, defense is going to create a lot of demand in this regime for commodities. New era in wars, right? You need to build these ballistic missiles, drones, and battleships. These are again very metal savvy, very commodity heavy, but unfortunately not very efficient for the economies. They are going to be inflationary. So 6 disruptive Ds, from divestment to defense. I think it's a new era. This is something new that we started living in, and that's going to create what I believe is a tailwind for the commodities, but not, unfortunately, they will be a headwind for the traditional assets like stocks and bonds. So commodities will play a very important role in kind of like completing this asset allocation puzzle, and I think they will be indispensable.
Okay, I have 2 final questions, but we're almost out of time, so we have to keep
Sure.
these quick. One of our viewers actually pointed out yesterday, that we keep hearing about potential shortages tied to the AI build out, specifically power, natural gas, copper, even things like helium. If that starts to pressure margins for companies, does that actually strengthen the case for owning the commodities instead of the stocks? Or why should I own the commodity as opposed to the stock that might be associated with the commodity?
Sure. Yeah, definitely. I think, look, if AI is going to hit a wall, it's going to be a supply wall. A supply wall through kind of like coming from this copper build out, or data center build out, through you need the steel and aluminum, and then the fuel that's required to power these things. So you cannot take commodities away from an AI trade. And in my opinion, they seem like a cheaper way of proxy AI bet. And instead of buying these hyperscalers at multiples that to many people doesn't make sense. In order for that to happen, you gotta have to see an increase in the demand for these metals, and which are currently cheap at bargain prices almost. So it's better to get exposure, or another alternative exposure through metals and commodities themselves as well. But I would like to refrain from kind of recommending going out and buying the miners or the producers themselves, because when you look at these mining companies, when you look at the natural resource companies, they are still equities. They have market beta, and they are correlated with the underlying, whether it's your S&P 500 or MSCI ACWI. So you're not getting the true benefit of diversification. Their market correlations are high. When you look at their underlying pure commodity betas, or what you get if let's say copper prices increase 10%, how much is your miners going to increase? That beta is very low. In the case of energy, for example, it's every 10% increase in oil price reflects 3% increase in your sector's inspired energy. And similarly in metals and mining, the only difference is in the gold miners. It's a exception. But again, instead of going out and trying to select the best gold miner out there, get your precious metals through a gold futures contract and target it at the volatility that you're comfortable taking as an investment. So it's a lot more efficient. It's a better bang for the buck in terms of doing capital allocation. So and then you don't have to deal with whether your companies are hedging their production books and then capping the upside. So underlying pure commodities are better way to go, best execution option in my opinion, and that's what I think we would like to prefer when creating a broad basket commodity to deal with the inflationary issues that we are facing these days.
Okay, so to wrap, we don't typically do our rapid fire segment for ETF Spotlights, but I have one rapid fire question for you. So it's just a 2 to 3 word response here. Bottom line, should investors be adding commodities right now or wait for a pullback?
I think they should dollar cost average. Don't trade headline to headline. It's not a good, investment policy. Increase your allocations gradually. That has been a better working, policy for us, and I've seen academically as well. So, patience beats, timing. Just be patient and gradually increase allocations from here.
We'll leave it there. Hakan Kaya, Senior Portfolio Manager, Neuberger Berman. Thank you so much. Really appreciate you shedding some light on this space.
Thank you very much, and pleasure being with you today. Bye.
If you're interested in how data is driving investment decisions right now, check out our recent ETF Spotlight on quant strategies and what the models are signaling in this market.